Okay, thanks, John, and thanks to the whole team here. Again, love this platform. You know, we're doing a lot of online Zoom stuff, and all these conferences, of course, for the last almost year now have been online, and think they will be for going on throughout this year. But still feel these town hall calls are, you know, it's the part of it that I enjoy the most. I'd rather talk to a lot of people who are interested shareholders than go through the pitch half an hour at a time, you know, with a series of meetings at these Zoom conferences. Very, very tiring. Not quite like being in Zurich or, you know, in Florida or in some of the nice places we've traditionally gotten to go to do the gold conferences. I'm going to go ahead and jump right in. I want to, like always, leave time at the end for our Q&A, and so we can quickly jump by the forward-looking statements, because you guys all know that I make plenty of those. And back to our basic slide of why investing in ELY Gold Royalties. And you know, it's I've changed this slide a little bit, but it remains the same. The base case hasn't really changed. We're Nevada focused and gold focused. We've outperformed all royalty companies, both on a price and execution basis. If you look at it from a number of assets that we've added in the last 12 months. You know, the stock, of course, has corrected, so we're not quite as undervalued as we once, or we're more undervalued now than we were at the peak, but where we kind of played some catch up about mid-year. But again, you want to be in the royalty space. Junior royalty companies, always a good place to be for X growth. And then a couple of new things, you know, in this what's becoming a crowded royalty space, we continue to not do two things. One, we're not out overpaying for current production or real near-term production. We're seeing deals go off at 2 times NAV for, you know, kind of current production assets in these competitive bid situations. And give you one example on our consensus slide. I'll get to it in a minute, but we'll talk about you know, some of the one of the companies that did overpay for some significant assets, and it cost their shareholders we think quite a bit on a net asset value basis. So again, that large strategic portfolio in Nevada, we think will always trade at a premium. So let's just go over the review. 2020, we increased shareholder value by 472%. That's December 31st to January, or January 1st to December 31st, 2020. Fully diluted market cap increased from approximately 51 million to 241 million. We did very successful oversubscribed private placement, where we added some new institutional shareholders. We added research coverage from 2 firms, Noble Capital Markets in the US, initiated in March 2020. Their current target is 215, and Laurentian Bank came on in October 2020 with a target of $2. So over the year, we added 6 key assets through royalty purchases that doubled the size of our key asset portfolio. We purchased 12 development portfolio royalties. These are the royalties that are at or near producing mines, maybe not on the entire property, but on strategic properties that, you know, make up a part of a larger resource, or like I said, are around producing mines that where our property has a very good chance of producing a royalty. And then we added 13 properties to our sale portfolio. So right now we have 27 properties in that sale portfolio at different stages of being purchased on the that 4-year option model that we do, and so that is always giving us nice cash flow and revenue. So all in all, a very successful year, but we can't we can't just talk about what we did. We want to also talk about the stock price. And so looking at our chart, it a chart for a long time I was very proud of. Not the most bullish chart here, but just want to point out that in respect to gold, not that much different. In respect to Franco-Nevada, almost identical. And in the case of Barrick, again, very similar with those 250-day moving averages being, not having held up here recently. But I would be remiss if I didn't compare us to one of what we think are key competitors, and a company that we like to compare ourselves a lot to is Metalla. Did some things. I mean, a great company. I always try and take my hat off to these guys for execution, and you can see that while they started to, we took off while they were consolidating at mid-year, and then they played some catch up and started to go through the correction we did. But late in the year, they were successful because of their New York Stock Exchange American listing and that liquidity. They were able to get into 3 different index funds, including the GDXJ. You can see the spike in volume there in December when they got in there, but they'd also gotten into a couple of others in November there at year end. And that's just been very successful for shareholders. So hats off to the Metalla guys. And we'll talk about our goals for this year, where we're just about 1 year behind them. What they did last year on corporate finance is one of our major goals for this year. So despite our correction, again, our friends at Metalla, they don't use us in their comparisons that I've ever seen. But despite our correction, we still have outperformed all the other royalty companies. This being Metalla, snapping at our heels here as it looks like we're diverging there. But we're still proud of what we've accomplished this last year. And then this comparison chart I brought up to date. This uses Refinitiv, which does a consensus of all the analysts covering the stocks. So, the key for us here is, and for the comparisons, I think probably the clearest comparison, especially in the junior space, is at the price to NAV ratio. And unfortunately, we have a couple in here that EMX, the consensus, they don't have a number on them, or Abitibi, but you can see that we continue to be around just under 1 times NAV. Nomad guys are at about 1.3. This is one I want to point out that I talked about before, is they made a major purchase this year. Well, 2 major purchases: the Coral Gold and also the Moss Mine. 2 great royalties, 2 that we competed on. We just couldn't see the price that was ultimately paid there. We thought it was maybe as high as 2 times NAV based on our calculations. And I would point out that if you look back at our November comparison here, their net asset value, and again, this isn't our number, this is the consensus from Refinitiv, dropped from $1.24 to 82. So this is the impact that paying too much for royalties in this market just to get current revenue and just overpaying in general for assets, really kind of clip their shareholders on the net asset value. And for us, that's the key. What we're trying to do here is build net asset value. And so we focus, even though you look out, our portfolio is we think one of the best on the development side. Certainly put it up against any of the competitors here, even Metalla. when you dig down through all of our assets and look out 2 or 3 years as things are being developed. And there's just a lot better value there in the market. You know, if for us, we can still buy royalties at 0.25 to 0.5 times NAV, and which are accretive with even at our 0.9 times NAV current multiple. Those transactions are still accretive to our NAV number. So look at that. You notice that Metalla has jumped up quite a bit, trading because of the current increase higher than any other royalty company in the universe, really. Even Franco-Nevada, the mainstay there, at 2.32 times NAV, and Royal Gold, Wheaton Precious Metals closer to 2, and then Cisco starting to pick up steam here as analysts are realizing, as they've been realizing value. So their NAV number is going up faster than their stock price these days. And so this is a key number to look at, and something to pay attention to with the junior companies as they are acquiring royalties. What is the impact? What are they paying? And because we are, expect to be cash flow positive and profitable this year, we are, we're staying away from paying 2 times NAV for current production, and instead buying value in solid long-term projects with good operators. And our strategy is to, be looking out to what this company would look like in 2023, 2024. So just overview on the whole portfolio with the addition. We had Rawhide coming on stream this year, so we're looking to see some payments there on the net profit interest, giving us 4 royalties currently producing, 8 that of the key assets that will reach production by 2025. In the development portfolio, we now have 26, and then exploration assets at 20. We have 40. So still have properties available for sale, and so given that there's, I think, a half a dozen of these are in Canada now, with the addition of the Côté royalty here recently, then but still a very Nevada-focused and Nevada-rich portfolio. They drill down on those key assets a bit, and we can talk about some of them. I know we had a question, but I want to talk about a couple of things here. Isabella Pearl keeps chugging along. They're now exploring and showing some very good results for mine expansion there on our 2.5% interest NSR, or 2.5% NSR. Jarrett Canyon is again chugging along. We're looking at it as being fairly consistent this year, although that mine is only operating at half a capacity. So we do have upside in Blue Sky as they are now able to dewater there and go back to deeper into some of the high-grade sections of the mine. We see some blue sky and some chance for these numbers to increase. The Fenelon we'll talk about quickly here with the recent news. And as you guys all know, I've been sticking my neck out all last year talking about them going ahead and getting that small miners permit and using that for a source of cash flow and development. If you look, I mean, not that it really matters, but if you do look at their presentation from as late as December, they were talking of near-term production, something they hadn't been doing all year, but they started talking about it in November and December last year and including it in the presentation. Then they did an about face here that they announced earlier this week, where they're pulling that permit for the small miners and instead going to look at the full development here. I had always said that for them to develop these areas here in the Tabasco and Cayenne zones, that was going to be necessary for them to go ahead and increase the infrastructure, mine the main Gabbro zone at 500 tons a day, go ahead and toll mill it, and send it off, and get down here to where they could explore, do development drilling here with 50 to 100 meter holes, as opposed to 650, 750 meter holes from surface. So that is still the case. I'm right there. What they have decided here is to pull that permit, and I think they blame the First Nations on that, and I'll explain my thoughts on that just quickly. Is that the permit that they would have gotten, the small miners permit, the EIS, the environmental impact for that, of course, included no mill, no tailings ponds, no dams, no, even significant waste piles, that type of thing. And that wasn't going to be consistent. They were going to have to turn around, and because they are going to build a mill there, and immediately start doing a new environmental impact study. And so they felt that it was it best just to pull that permit and go ahead and look down the road towards, what this project really should be. And we won't know that for sure till late this year, but the analysts, when they come out with the resource and a mine plan or a PEA, but we think there's 3.5 to 4 million ounces there that they've outlined so far. We think 1 million of that is in the main Gabbro zone. And what they have decided to do is start a new drift and for mining purposes. So they'll actually have 2 accesses to this, and they're going to access this with a new drift, which would allow them to obviously mine at 2 places. At least this is our understanding of it. So they're still going to get down here through development work, what they call development mining, and coming down through some space where they won't be hitting all the stopes, but to get down here. So anyway, that's the story on Wallbridge. We'll kind of look at it in a minute when we talk about the rest of the revenue story. So Lincoln Hill, we announced the closure of that extra 2%. That is flowing along here with there. I've started construction of the new leach pad there. They've got 2 drill rigs on site at Lincoln Hill. We also announced a small royalty at Lincoln Hill on 3 claims that are kind of in the middle of the ore body there. We're waiting to hear back from Coeur on their right of first refusal on that. So not a significant purchase, but again, part of our business model is we like, once we get involved in a project like this, we see it going ahead with a key top operator, we like to add on. Same thing that we've done at Marigold with the announcement of the Trenton Canyon royalty. We're looking to maybe add to that position, but of course that one is still the resource on our claims, which is scheduled to start production in 2022, is growing as they're exploring there. At Ren, we were able to get past the COVID restrictions, and Jerry was able to do a site visit here recently. So we've got a bit of an update here as far as Ren. This is of course the underground at Gold Strike here. The open pit is about 50 million ounces from right in here, and Ren, of course, right on trend here, and probably possibly one of the best zip codes in the world. A couple of new pictures that Jerry brought back from the guys at this picture on the right was on the wall at there at Gold Strike. Shows the where they're drifting in from and their plan here for just the Ren deposit alone that's already been outlined. So it's now showing up on the map here. Jerry was able to actually go underground and see what they're doing with the drift. The drift is actually in a little over 5,000 feet now. So it's way ahead of schedule for what we thought. But they're basically over the ore body now. They're and doing more exploration as they go along here, looking at some areas, throughout these structures that look interesting to them. And these guys, I mean, they've been mining here for a long time. They've got senior guys there with tons of experience that know this ground. Obviously, it's very similar geologically to all the underground mining that's gone on at Gold Strike. So, we're very excited and think that this is the future of this mine. And well, we've got a couple million ounces outlined, and we did file a 43-101 on Ren here recently. We think there's much more potential there than just that 2 million ounces. So, and of course, then we also have the NPI on Ren, which again, we're as time goes on here, we'll be able to get a better idea of what their costs are. As far as the development, but very excited that they've gone ahead and drifted into that property. As we thought they were just getting started with that, and come to find out they've maybe been working there longer than we thought. Hog Ranch is moving through the permitting. Railroad, the new royalty we picked up, I might comment on that. We were supposed to buy about a little over 1% royalty there. We actually closed the best piece, the piece that had no advance royalty payments, and about it's about a 0.44% royalty. This, for those who haven't seen the map on it, it's part of the checkerboard, the yellow mineral interest. So it covers a big chunk of the Pinion resource, about half of the existing resource, and all of the $1,400 pit. And all of this is where they're currently exploring and putting out drill results. So they're expanding this to the south. And then at Dark Star, they just came out with a couple of these holes over here to the right. We didn't have a chance to get them up onto the map yet, but all the exploration at Dark Star Main is they've had some very encouraging at surface holes right outside the pit, which will probably get included into the pit since it's right at surface, is the way they're talking. They've also added a whole new management team for putting this mine into construction, and of course they have the financing from Orion. So we're disappointed at the 11th hour. One of the other major property owners there raised the price on that to us, and again, we're not in the habit of overpaying. The ones that were raising the price to us, also their lease payments were advance royalty payments, and the piece we have with about $80,000 a year US of lease payments are not advance royalty payments. So, and Gold Rock with Fiore, of course, continues to proceed as well. So we've changed our revenue, pulling out anything from Fenelon. The analysts at Laurentian, who covers us, and working with some other analysts, they're looking at kind of push things out to 2025. But now, instead of looking at the 2 million plus of revenue that we had scheduled starting this year from the small miners permit and then escalating out there, we're now looking at something that is going to most likely be somewhere around 200,000 ounce a year operation, and most likely starting in 2025. So we still are looking at a solid year this year and next year with our development projects then really kicking in 23, 24, and and 25 should be, you know, assuming is when we get better visibility on Fenelon, we'll be able to actually plug that in here on the graph. But we think that's a fairly reasonable number looking out to 2025. The I'm just going to backtrack just a little bit for anybody who's new to this story here, just so you understand how we differentiate ourselves and how we're building this company and building shareholder value. Is you know, on the business model, we're purchasing and generating royalties through our sale program. Somebody asked, you know, about Blackrock. You know, they continue to have great drill results. Looks like they're working already towards a PEA. They haven't had that project even a year yet, but we consolidated that for them, sold it to them for $3 million over 4 years, and kept a 3% royalty. So, you know, where you'll see our competitors out buying exploration royalties like this, we like to get paid to generate them, and we think that business model makes a lot more sense for that to be involved in the exploration royalties that way. As far as management execution, you know, we've added 18 royalties in 2020 and 16 property sales. So Jerry and I are very busy, you know, getting deals done. On the liquidity side, we upgraded this in 2020 to the OTCQX and picked up that analyst coverage. And, you know, again, we always point out when you're looking at these development and earlier stage royalty companies, you want to look at that path to production. And we think we have a very clear path to production in that we have 12 key assets. 9 of them are already at mines that are producing. 4 of them are already producing, and they are with some of the top operators in the business. Most are financed. You know, there's only 2 in here, the Rex Minerals and Gold Standards, that aren't actually operating mines in their jurisdiction. So very, very clear path to production for our assets. To bring you up to date on our corporate side, 161 million shares outstanding, 201 fully diluted. I'm just going to make a comment on a couple of things that I see shareholders talking about. Is, you know, our slug of warrants. You know, 10 million of those are at $1 from the financing. None of those have been exercised. Eric Sprott holds about, I think, 15 million of those, and are outstanding warrants, and he's not selling. So while there's some, you know, upside potential, we are quoting still. A few of our warrants are out of the money, but we're really quoting everything. And the exercise proceeds are just based on in the money. But, you know, looking at our market cap when we compare ourselves on a fully diluted basis to like on the peer sheet and that kind of thing. So once we got everything closed this year, we've got about 7.2 million in cash, about $1 million in share of some of our operator companies, and a little bit of debt here that will pay off over the next couple of years. That was spread out over 3 years on the Jarrett Canyon purchase. And we still have $6 million in our line of credit that's been untapped. The shareholder breakup hasn't really changed much. You know, I like to still think on a long-term basis, on a weekly chart. We're still, you know, kind of. We think still our uptrend, long-term uptrend, is intact, and we think that it's just a matter of time here before the gold stocks, you know, start to take off again. So and jump through the management thing and talk about our 2021 goals. Number 1 goal for 2021 is to be profitable. We're really working on the budget and the G&A and the promotional expense. You know, we've spent the last couple of years overpaying to get our name out in the market and to try a lot of different things. And then, that got compounded with the COVID last year and going to virtual. And over that time, we've continued to, we started with another group, Otis and Mandy, and then have switched over this last year to the Follow the Money guys doing these town halls. We think this is the basis of our reaching our shareholders. We'll still do some of the virtual shows, but we're cutting way back on those this year. We just don't see the value. We know who these people are. We can set up one-to-one Zoom calls with the institutional people who are interested in our stock, and they appreciate that much more than and it's just not very effective doing these virtual shows where you're doing a presentation every 20-30 minutes and really not getting to know people online the way you do face to face. So the other thing in this, I'll pull back to the Metalla. This is what they did last year. We're basically, I think, a year behind them is where it would be. We are just finishing up and filing our what's called the annual information form. That will allow us then to file our first prospectus so that any financing we do in the future, whether it's an at the market or which a lot of people are doing, I'm not saying we're doing that, but any financing will be prospectus so that we can bring in other shareholders. That'll also, kind of point the way for us with that prospectus to be looking at a listing on the NYSE American later this year. That would probably require us reversing the shares, again, similar to the way Metalla did it. And then once you have that listing, that's where we're open to getting in. And we think we're a very good candidate based on our portfolio, our growth, our relationships, our Nevada gold focus to seeking and getting into some of these indexes. The GDXJ, for example, only has 3 royalty companies in it now: Osisko, Sandstorm, and Metalla. So there's plenty of room, and you can look at, go to the GDXJ Van X site and see all the other smaller companies that are in it, and see that there's we're certainly on a market value basis, a market cap, and all we need is that liquidity and listing, and I think we have a very good chance of following that path to getting into the indexes. Obviously makes a big difference. We're going to strive to get some more additional research, one more U.S. bank and one more Canadian bank, working with them there. So we're pretty comfortable with that goal. And then just continuing to execute the business model. We'd like to add 6 more key assets this year. That seemed like a good number last year, and we think that's achievable. We have one we're working on right now that if we can get it signed up, would be a nice start to the year here in January. Those development assets we continue to pick up where they're adding on to the existing portfolio or some new things. But those ones that are at or near producing mines are part of bigger assets that are in the permitting process to become mines. We like those. They're not company builders on their own, most of them, but they are going to add, some nice growth and it makes that portfolio kind of shine compared to and a stepping stone, if you will, between our exploration portfolio and our key assets. And then to add an additional 12 sale properties to the portfolio, that would just be typical of what we do in a year. And we're still seeing very big demand for exploration properties in Nevada. And, we'll continue, we'll be probably on the same path where we announce about a deal a month there, and should have one to talk about here pretty quick in in January. So again, that brings us to the end, and so we can open it up for some Q&A. We think that there's still a great value proposition here, maybe even better as things have pulled back. We're disciplined in our approach, not buying exploration royalties, but focusing on purchasing key assets or development assets only, generating those exploration royalties, and not overpaying for near-term production. We certainly would love it if we could find it, but if we're trading at 1x NAV or just under, for us to go out and pay 2x NAV is just going to dilute our NAV. And we think that the value is always going to come back in these junior and in royalty companies to the multiple of NAV. And certainly and as our portfolio matures here, I think by 2023 anyway, you're going to see us also be competitive on that multiple of cash flow or multiple of EBITDA or everything where we are not right now. But neither are our competitors. I mean, I might point out that the Nomad guys, they've purchased more upfront kind of revenue things, so that they are they stack up pretty well on that front. But we're just not willing to overpay for that revenue here. But would rather keep buying things at a deep discount to NAV with long life, good quality assets that preferably the mine's already developed, and with great operators. And we don't want to dilute our portfolio on any of those counts. So that's it. Let's John. I see John's back. He's the maestro now to see if we can answer some questions.
Okay. Yeah. Thanks, Trey. Appreciate the presentation. Anyone, if you haven't submitted a question already, please do so in the Q&A section. If you happen to have asked a question in the chat, just so you're aware, I would have moved it over into the Q&A in case you were wondering where your question went. But let's start with Owen. He's asking about Blackrock and the recent news they've had there. Are the implications, or what are the implications for ELY, and is it becoming more important?
Well, look, the Blackrock guys are having incredible success there. That's we put together a great project for them, and we've got I mean, they are really good exploration guys. I think most people probably know Bill Howell from Rye Patch Gold. He knows Nevada as well as anyone, basically running the exploration program there. So showing very good results on both silver and gold combined. And of course, for us, it means that they're looking at coming out with a resource pretty soon here. It's looking more and more like a project that can start to work its way up to our development portfolio. And if they're really able to put it together as quickly as they're talking, could become a key asset by the end of this year, meaning that they're talking about a production story out before 2025. So we like the guys a lot. We like the fact that they're paying us $750,000 a year, or we'll get a $750,000 payment this year, and that on the backside we have a 3% royalty on that project.
Okay. Now you did mention it in your presentation, but I don't know if you want to elaborate on it. James is asking about a reverse split, and then any plan for a dividend. I think you had already talked about reverse split for an uplisting, but
look, the reverse split is something that in the junior mining space can be misconceived, because most people who experience reverse splits, it's just a way of them losing more money. We would only do a reverse split at this point if as part of a strategy, you do to get the New York Stock Exchange listing, you do have to have a minimum stock price of $3. I believe it still is. And you don't want to start right at $3 in case your stock goes down. But so that would be required in that, something that, again, as our share count has moved up, not to unmanageable levels here, but it would help, I think, from a stock standpoint to have a higher price stock with less shares outstanding. And as far as the dividend, look, I think I probably should add that to the slide, but our number one goal this year is to be profitable. And, a company has to be profitable before it can pay a dividend. We're not going to declare a dividend and then pull it out and blame it on COVID or U.S. election results or anything else. I mean, it's you have to be profitable first, and then you can look at a dividend program. I'd say for us, profitability is still on the horizon. Certainly, the wall bridge not coming to pass the way we had envisioned it might restrict us a bit on having money for the dividend. But look, as long as we are seeing and able to reinvest funds at 0.25 to 0.5 times NAV, and hopefully we'll get re-rated a bit this year when the market straightens itself out for gold and gold stocks, which we think will happen. Then we're probably best off. Then that's probably better use of the money. Now, if, I would certainly, when we have the revenue and the profitability and the revenue, if we saw a situation where we weren't able to reinvest the money at a deep discount to NAV, or and when revenue really starts to accelerate in 23, 24, then certainly that's where we would look at being a dividend payer.
Okay. There was a question that just came in, Trey, related to an uplisting, and so I might as well ask it now. And they're just asking, can ELY afford the expenses of listing?
Sure. We should have. We're looking at somewhere, just south of $8 million in revenue this year. We don't have a lot of G&A, that we're going to have a lot less G&A. So I think basically we could have, with what we are going to save this year in promotional costs, by coming directly to the shareholders through social media and town halls, that money it could be earmarked and will be earmarked for the listing.
Okay. Phil is asking, with the 6.5% total encumbrance on the Wren property, do you think this will affect its development, and is it under dispute?
Not sure what he means by dispute, and I'm not sure I agree with Phil's number on 6.5% total encumbrance on the Wren property. To my knowledge, the only royalty on the Wren property is a 3% NSR. I know what he's doing. He's adding up. Okay. So the only NSR on the Wren property is a 3%, of which we own half, and we're actually partners with the people in an LLC that own the other half. So we have 1%, they 1.5%, they have 1.5%. The 3.5% net profit interest, just to make sure, understanding that a net profit interest is something that's paid not off the top line like an NSR, but off the bottom line, almost like a dividend. But it's a compelled dividend. So they get to deduct all their operating costs, they get to deduct everything, and then pay us at 3.5% of their net profit on the property. We're we're somewhat, these net profit interests can always be difficult. I mean, when we purchased that, we bought it so cheap and at such a discount to NAV, and I basically threw the kitchen sink at the cost. I took all of the costs that for all of the development at Gold Strike and subtracted it out, and then their operating costs at Gold Strike are pretty much set. I mean, they're public domain information because they've been operating for so long. So it's not really a true encumbrance. So I don't know if the dispute is a question on any of that, but I can tell you a net profit interest is always disputed by one or both sides, and it ends up being a settlement, an agreement, a point where we have the advantage here where they are in the joint venture on this with Newmont. So they kind of publicly have to disclose, and again, the company's trying to make money, so they can't, they don't have an incentive always to just, they can't throw numbers at us that they're not throwing at the rest of the market. But anyway, I hope that answers his question.
Yeah, Phil, if you have a follow-up to that, you can always put it in the Q&A. So the next question, Trey, was from Heinz. He's asking, and this question seems to come up often, what impact might the new administration have on permits in Nevada?
Well, look, I think permitting certainly got easier under the Trump administration. It didn't change markedly. I mean, if you think about all of the agencies that were coming out of 8 years of the Obama administration, and I mean, this includes the FBI and I mean the EPA, of course. They got some. There were, those agencies are filled with career people, and their individual and the local opinions of those people doesn't change with the administration. If somebody, at the BLM at a certain office or with the Forest Service at a certain ranger station is mining friendly, then they're mining friendly. If they're not, they're not. And now it does, what the edict that comes down and some executive orders that may have come down, I think, they did come down to the BLM as far as permitting, down to the EPA. They certainly made some changes there, but we didn't really see a lot of that get implicated, have much implications at the local level. In other words, the people are told, here, you need to do this and this, and basically they just kept doing what they were doing before because they're human beings. And it's not that they didn't listen, it's just that it's kind of business as usual. So I think it'll get tougher. I think that in Nevada you have the advantage of a very mining friendly state, kind of getting to be a blue state, very mining friendly. You've got the BLM and Forest Service ground. Mining is going to be looked at more and more as essential, and and I think more and more that we need local sources for it here. That may apply more to the battery and other electric vehicle EV metals, but I think it's just something in general that we want to become more independent. So I think it'll be negligible. I wouldn't want to be on that permitting side with a single project that had any kind of questionable environmental issues with it. under any administration. So that's again why we focus on our key assets. 9 of them, the mine's already built. The permits are already in place. Even for the expansions that will include our royalties and our claims. The permit at Ren for mining is in place there. So we don't think it'll have a big impact on us.
Okay. Heinz, I hope that answers your question. That was pretty good, thorough answer from Trey there. Trey, just a follow-up to what we've already talked about earlier, but Randy was asking if you were to do a consolidation of shares, at what do you know what ratio you would expect it to happen at, or you did evaluate that?
It depends on current stock price. I mean, but let's just say if you did it today, I mean, you'd probably want to be to do a listing. You'd probably want to be a $5 stock. So you could do the math. I mean, like I said, you have to be 3, and $3 is the minimum listing price, and you don't want to be falling below that right away. So you give yourself some upside. I think if you look back at Metal, I'm pretty sure when they did their reverse, they were a $5, $6 stock. So that's probably the right level. While I'm on that too, I want to speak, I started to speak a little bit more about the dilution, but I wanted to talk about some of the insider sales and purchases here recently. A few of us had some warrants that were going to expire here in January, so we exercised them. I have not sold a share of stock since I've been with the company about 10 years. We've had a couple of our directors, specifically Bill Sheriff's probably been the biggest seller. He didn't have any of these longer dated warrants that are just getting exercised. I may go ahead and even exercise more of my lower priced options, but again, with no intention of selling. There were a couple of recent sales. I can tell you that Bill Sheriff comes up as a seller, but he actually didn't sell it. He sold it to he crossed it to family. So I think that we don't pay our directors anything, so for them to we don't like to restrict them too much on their ability to take some money off the table. I don't think it's any indication of what's going on, but I can tell you from my standpoint, from Jerry, from Steve Kenwood, from the major, management people at this company, you are not seeing insider selling. You have not seen any, and I can't say forever, but I have no intention of selling stock. Neither does Jerry.
Okay. There was a question on potential dilution, Trey, around the significant percentage of warrants outstanding. I think you've already talked about that a bit. Did you want to elaborate anything?
Well, just that, like I said, there's no potential dilution. We are quoting everything on a fully diluted basis. So when we compare ourselves, we're using all 200 million shares. Oops, excuse me, I might have gone too far. Okay, so you look at this, the warrants, to the extent there's not dilution. I would worry less about dilution because we're valuing ourselves and we're valuing us on the basis of our NAV and our price to NAV and our NAV per share on a fully diluted basis, as if every warrant were exercised, even the ones out of the money. Now, the exercise proceeds here only include the ones in the money. So that number really is more like but you can't start including exercise proceeds at out of the money options. But that's maybe just a few million is total of out of the money options on some of these deals that we've done. I'll comment again. I've made the comment before on the warrants that we use when we're buying assets. We kind of look at it as financing. The people love it. We've got a very good reputation now with a lot of these old timers in Nevada. They talk with each other, and that's why we get calls nobody else gets some of these, the ability to purchase these assets. Some people have done very good selling us and getting warrants. But when we do a warrant, I mean, if you guys look at it, and say in the case of okay, the most recent Walker small deal, but it was we're paying 300,000, and I think it's maybe 300,000 warrants, 200. I'm losing it here a bit on that, but we kind of look at it and say, okay, at the current price, if things work out, basically we're getting our money back that we put up, and that's how we look at the warrants. The other side looks at them as an attractive speculation, and we sell them that way. But we're not afraid to add that kind of dilution, and we look at it as basically a way of financing the purchase longer term. So worry less about dilution and more about pressure on the stock. I mean, we do have 10 million warrants that are in institutional hands, mostly from the private placement in May. Those are at $1. We haven't seen any of them exercised yet, but those people bought the stock was priced at 80 cents, and they got a $1, a half a $1 warrant. So at one point, when the stock takes off again, there's going to be selling pressure from the warrants. That's what I would worry about, less than dilution.
Okay. The next question's from Andrew. He's asking any updates on the potential for the remaining 50% of VEK Andrus.
Yeah, I don't know. We are still working on 25% of the remaining 50. The other 25 is pretty much said they don't want to be sellers at really at any price. So that could change at any time. Like I said, we're still looking at the potential to add there if we can, but I would have to say that the potential is at 25% of the remaining, not 50.
Okay. This is a charting question, Trey, and I know you like your charts. Michael was just commenting from a purely TA perspective. He sees a descending triangle which portends lower prices. Why might the market not be pricing in your recent royalty deals?
Well, I think one reason is the market's always seems to be, is much more focused on those near-term producing royalties. So looking at ours on, where we think we're buying the best value, paying 0.25, 0.3 in the case of railroad times NAV for that royalty. But it's longer term out. You talk about descending triangles, and again, I'll point back to I think it's safe to say, and anybody who does technical analysis, to really see gold start to look strong again, it's 9 times out of 10 preceded by a move in the major companies. So that's why I've when I put these charts together, I mean, obviously gold is a descending triangle here on this chart, along with ours. Descending triangles also have a point at which they have support, and if you draw this line across here, starting with this peak here back in February, March, across, and we're starting to build up pretty good support line at the bottom. So that descending triangle, on a technical basis, you would want to see this line hold, but it's more a case of gold straightening itself out, and whether it's Franco-Nevada, has basically, to us, if you look at it, very similar chart here with descending triangle, but here's your support over in here, here and here, trading right on support, and and we certainly think and hope it holds here as gold straightens itself out. Barrick, same situation. And I think, we started to maybe see last week where we had a little spike, got above the 250 or the 50-day moving average. Gold popped up, in a week about $100, and then, proceeded to just give it all back. So, not great looking charts here, but ours no different from anyone else. And I think that this is a good entry point for our stock, based on not just a technical basis where where you're buying it at support and hoping support holds, right? But also on a fundamental basis for us, because compared to our peers, we're undervalued. We are adding these assets, and as we get through this year, and gold gets itself straightened out, you're looking at a big risk on trade right now. I don't care if you look at the chart of Tesla, Bitcoin, they're almost identical charts here, and and a lot of other assets that this with the money supply up, since it's a technical question. I mean, I don't have the chart in front of me here, but I can tell you, and I can send it to anybody who cares, is the true money supply chart, which is all of Europe and the US, is up at about 25%. Generally 12 to 15% is the highest it's ever gotten in the past, and that would have been really like World War II kind of numbers. In the US, though, actually Europe their money supply is only up about 15 to 20%. Ours is actually up, US alone, up over 35%. I mean, the highest ever was 15%. Some of you older guys, younger guys probably don't know this, but it used to be in the 80s. That's all anybody ever looked at. Never looked at employment numbers or anything else. It was always money supply number was the number that you looked at, monthly. It was the number everybody waited for. And money supply it's out of control here at up over 35% in the US. And you're starting to see that reflected now in risk on for all commodities, beans in the teens, gold back above, or oil back above $50, copper at 360. And I think that's going to continue until it doesn't. And the stock market, same way, higher every day. Doesn't matter how bad things get in the US market seems to go higher until it doesn't. And when it doesn't, and the risk off trade comes on, that's gold. So I think that'll be something I believe we're going to see sometime this year, maybe sooner rather than later.
Okay. Perry's asking a question about silver and ELY Gold's exposure to silver. Could you talk about that?
Silver, we have very little. Tonapah would be some silver exposure. We would like to get more silver exposure. We've looked at some deals, but again, the deals we've looked at, silver's very hard unless, because first of all, with our geographical focus in Nevada, very little silver coming out of the silver state anymore. It's all gold. And then even Canada, to get any real silver exposure in Canada, you'd be looking at a polymetallic mine. And while now that zinc prices and lead prices are going up, those are more attractive. But typically, an NSR, you really have to watch those polymetallics because they get to deduct expenses that a straight gold or a straight silver mine or a gold and silver mine doesn't get to deduct. And those are costs that are penalty pricing that goes into what the smelters and or the whoever's the middleman there charges. They'll put penalties, the zinc price penalty, lead price penalty, and so very tough to value those, and you really have to drill down and you're kind of at the whims of different different factors. Silver streams kind of hard to buy unless you're at the front end of those financing them, something we haven't done yet. We would love to have more silver exposure. We don't have any problem with that. Personally, I bought some physical silver this week, so we love silver. Just very hard to find, and again, my hat's off to the Medela guys for searching out and finding some nice silver assets.
Okay, thanks, Trey. One question, there's a few people that have had sort of a similar question, and it came up in our last town hall was, is ELY Gold looking outside of North America or outside of the US to generate royalties or properties sales?
The answer is yes. We are looking, although, for us, one thing we're not doing is running all around the world chasing royalties. So, I think you have to have a focus, and, whether you can look at a lot of the different companies, some of our competitors, I think that, the idea, for me, I do most of the contract work and a lot of the title work on the Nevada royalties, where it's probably as good as Nevada as anywhere in the world as far as knowing what it is you're buying. But still, we run into a lot of things where the royalties are contractual, they're not actual deeds, and you're at the mercy of what the contract says or doesn't say, and contracts can always be interpreted differently. We like to have those deeded royalties, which you can get in Nevada, and we try and change our contractual royalties into deeded royalties. That's always an upgrade goal in the portfolio. I don't believe that these junior companies that are looking at things all over the world have any idea necessarily what they're buying in some of these foreign jurisdictions. I mean, that would scare me to death, not just what might happen in West Africa, but what I'm actually buying and what control do I have over doing it. The other thing that you have to take into consideration is we have a great legal team and advisors in Canada now, and we have a great legal team, and Jerry and I and Bill, we know Nevada as well as anybody from, up and, not only from the property standpoint with Jerry and Bill, but on the legal and contract side and title side with myself. Now, when these guys go and if you buy something in another jurisdiction, there's a good chance you're going to have that a lot of G&A is going to come with it. So you go into a new jurisdiction, chances are you're going to have a subsidiary there. You're going to have a legal help. You're probably going to have to accounting help, and you've got increased risk in exactly what it is you own if it's something contractual, and if you don't understand the local laws as far as deeded royalties and being very secure. So I think we are very cognizant of that, and so therefore, while we are looking, we think Brazil is very interesting. For example, having looked around North and South America at not just some individual opportunities, but the overall opportunities. I think there'll be more development in gold assets in Brazil over the next 5 to 10 years than anywhere else in South America. Certainly by number of projects. We do have some good contacts there as far as strategic advisors and a legal firm that we've started to talk to. So we've and it is an environment that we're starting to understand it legally. where, I mean, it is a situation where we would not have to have, we could buy assets there without necessarily having a local, a subsidiary in the country. So I think if you see us do something, you're going to see us do it strategically, and it'll be strategic in adding a jurisdiction that we feel is safe and is going to have a lot of opportunity, not just doing a bunch of one-offs in different countries that just adds that come with significant risk and G&A.
Okay. We're about an hour and 15 minutes in, so I'm probably going to cut off the new questions. We still have a number of them to get to, but probably cut off new questions. The next one, Trey, was from Steven. He's asking, are you seeing more companies purchasing ground just to sit on as a potential resource? What are you seeing on drill rigs, like numbers increasing or decreasing, etc.?
Well, I tell you, I'm not. I can speak, mostly to Canada and Nevada only. Mostly to Nevada, I mean, and to Nevada and Canada only. Lab times are at least three times what they were, and to get samples turned around. Drill rigs, I think you can still get drill rigs in Nevada. They're getting very tight in Canada. As far as the part of the properties, people sitting on properties, I can't really speak to that. I mean, I think, there's been some new entrants this last year into the market that have gone out and staked properties and are either billing themselves as project generators or that type of thing. Again, we only staked one property this September. It's very interesting, and we've already got a deal pending on it. So, it wasn't a great year for staking of properties, but we have found a couple of new things now through the database. We were able to, in the Trenton Canyon deal, both Trenton Canyon, we got a lot of new data, and we were able to then go through all the VEK data. So we're starting to generate some projects and stake some things based on that data that Jerry finds are very interesting. So we're still seeing a lot of demand. I mean, our phone is ringing all the time for people looking for projects. And well, I think I think right now the biggest issue is lab turnaround, and that can be, if you're on the exploration side, that can be very frustrating because you're looking for certain results, but and you've got the drill rig out there, you'd like to know what those things, but where you're going to, before you let the drill rig go, and have to pay to bring it back in again, you'd like to know, have those results out of the lab. And with the turnaround times that we're seeing now, it's a bit more challenging for these exploration managers to keep their projects going and being able to drill the targets based on both their geological interpretation and drill results, which is a lot better way to do it than just geological interpretation. I always say, you can take 3 geologists to a site, to interpret the geology, and you'll get 4, maybe 5 different opinions.
Yeah, the frustration that I've, the CEOs I've talked to, certainly in the exploration space, just incredibly frustrated, especially in Canada around the labs, trying to time capital raises and all kinds of things. Is just a mess right now because of it. A few people have asked a similar question, Trey. It's regarding M&A. Are you active on wanting to get bought out by a major, or is ELY heading for potential M&A? Someone asked sort of a similar question. Would ELY consider acquiring Oregon Royalty? It's a pretty specific question. I'm assuming you're not going to answer that one directly, but obviously
I can.
Some interest on the...
I noticed on the message board, so I promise that if anybody's coming, especially from the Stockhouse board, they which I'll comment on from time to time, and they've been talking about, they've been setting up my retirement party there on Stockhouse. So look, I think I've maybe mentioned before here my age. I'm 70 years old this year, and I'm not looking to retire, but I'm certainly of retirement age. So I'll say this about specifically Origin. We like those guys. We deal with them all the time. In Nevada, they're a competitor always were a competitor as AUEX, and then as I can't remember their name before they, but Bob Felder over there, we talked to quite a bit. We did a joint deal with them recently with Premier, where we combined two properties, and we didn't get any credit for it, but the best part of the property they just did with Premier is our property. So, they're probably, while they've got some things going on in Mexico and stuff with one royalty that is going into production, it's a silver royalty with First Majestic, and an interesting long-term play, which is just still would be in our exploration portfolio at this point because there's not enough data on it, is the deal they have on the Silicon property with Anglo. And that company is way too much levered towards the exploration side and towards the royalty generation side. We have that down. We feel like we have a good enough portfolio there. That to us a merger there would be too much like buying more exploration royalties, which we kind of are on record as saying we don't do because we get paid to generate those kind of royalties. So that specific one, I would say, it doesn't wouldn't make a lot of sense to me. On the other hand, there are other smaller royalty companies that would fit, and certainly ELY is at the point where it can be an acquirer of smaller royalty companies. The problem there being is that most of these are new on the scene. The managements are kind of entrenched. The reason most M&A deals don't get done is because of the personalities and the egos of the management and who's going to be in control and who's going to run this thing. And I don't know if there's a management team out there smaller than us that I would want to say, okay, you run this thing. I think we have a great business model. We execute very well. I don't think I wouldn't do that to the shareholders. If we were to do anything, the first consideration would be liquidity. I mean, you have to be increasing liquidity, not going sideways or down in liquidity for your shareholders. We're a public company, so I serve at the pleasure of the board of directors, of which I am one, and the board of directors serves at the pleasure of the shareholders. So we're working for the shareholders, not just to add shareholder value in any way that we can. So if that meant making an acquisition was the right thing to do versus just continuing to exercise our business model, then we certainly are always looking and thinking about that. I mean, my background is in M&A and investment banking, so I think about it all the time. I dream about it probably as much as I think about it. So, but on the upside of being acquired by a bigger company, look, it's always possible. If somebody, it's the problem with being, as we feel, undervalued in here. Our portfolio fits with just about anybody. You can look at some companies that have similar models to us in that they're more creative and generating royalties and more creative than just buying. But then you can look at Franco-Nevada, and I mean, our portfolio lines up very well with theirs. I mean, in fact, we share royalties. They have part of the same Marigold royalty we do. They have more. I mean, that company was built on the Goldstrike mine, so the Ren property would be a nice extension of what they, the royalties they already have. Of which, if you look at their website, you'll see they own, similar to us, royalties and NPIs on most of the property there at Goldstrike. So look, anything can happen. We are not actively out trying to trying to do anything. We're not hanging out the for sale sign, but we're always talking to people. We talk to the larger royalty companies about deals, literally all the time. I mean, of deals that are too big for us that we need to partner on, or other reasons. So, I think it's one of the upside of, again, in our stock being undervalued, is there certainly is always going to be a floor on it based on larger companies from an M&A standpoint. And we do have the advantage that, our company is very light on G&A. I mean, again, I probably haven't said this in a long time. Jerry and I are the only two full-time employees at the company. And kind of amazing what we've put together in 4 years. But we're the only ones with any kind of change. Well, Steve Kenwood, who's been with the company longer than I, up in Vancouver, who does our corporate secretary work and stuff. But our CFO is an outside accounting firm. We share our IR with other companies, Joanne. And so we have the unusual situation at ELY that, we are really a portfolio of assets that to a larger company doesn't necessarily come with a lot of extra management and G&A. In fact, in any kind of a buyout by another company, it's very possible that all the G&A goes away, and all they're buying is our, and that's very unusual, because usually, I mean, you're dragging along the management guys and stuff. So, but if a bigger company bought us, I mean, I can't see me needing a board seat at Franco-Nevada, should that ever happen, or any kind of management role for that matter. Maybe some kind of consultant thing, but so anyway, look, it's one of the reasons that we think that descending triangle is not meaning lower prices, that we're at that base, and that the stock should not get cheaper.
Okay, so very thorough answer for everyone looking for info on the M&A side of things. You mentioned Ren there just recently, Trey, and this is a follow-up question from Phil to what he asked earlier. He's saying the 43-101 on Ren was done without access cooperation. Is that normal? It feels like tension or a dispute. Thank you.
No. Say that. Is that regarding the 43-101? Is that what you said?
Yeah, on the 43-101.
No, actually, Jerry has made 2 site visits since then, but we needed to get the 43-101 done as a requirement for doing our annual information form. The requirement there is, and for the prospectus, both Canada and in the US, is that our key assets at least all have some type of a report. And Ren, being one of our larger net asset value positions, required a 43-101. So actually, there's an exemption in the 43-101 rule, and Bear Dolbear helped us both on the Jarrett Canyon and the Ren, in that if they can't make a site visit, there is an exemption that allows them to use just what's in the public domain. So if you notice on the Ren, it is shallow. It's based on, the Centerra work, their drill results, their resources, I believe from their 2010 annual report, from the 2004, is it 43-101? I mean, it's old, and and not up to date. But it's adequate because, well, one, it was required for us to do the AIF. So we actually wanted them to not let to go with that exemption. We had to, we were actually lucky that they had the COVID restrictions on and weren't allowing people to come to site. Since then, they lifted those and lifted it specifically for Jerry because he's got a good relationship with the guys there on the ground. But we will be, as this year goes on, in all likelihood, we will update that REN 43101. We're going to wait until we start to see some more drill results and stuff from Barrick. Luckily at REN, there is absolutely no contention on that. They are willing to give us anything on the data side. We have to be, there's some that will have to be more internal, and we're actually asking them. We don't at this point even want to see stuff that we can't disclose, or that we covered under a CA. But remember, at REN and Marigold, we have the unusual position of we own the property, or the partnership does. And it's leased, so we have access rights and rights to data that a royalty holder typically would not have. So no problems at REN. I mean, like I said, Jerry's been there. He's been underground. He walked out. I don't think he walked the whole mile out, but he was able to go into the drift, see where it connected at Banshee Underground, and so I think you'll see us. REN will really come on, and yes, you're right. REN has those big $250,000 a year lease payments to us, which are advanced royalty payments. So you have a production scenario starting in 2023, but having to work through some advanced royalty payments there. About the first, it's about $5 million, and first $5 million goes to advanced royalty payments once REN starts operating. But we think 2023 we're scheduling in the start of income from REN actually in 2024, and the other increase in 2023 would be from Lincoln Hill and Gold Rock.
Okay, and yeah, Trey, I think you just answered Stephen's question there, right? So just two or three more quick questions here. Bill is asking, Eric Sprott, is he playing an active role, and what is his projection?
Eric doesn't play an active role with management of any of the companies that he's invested in, really. He, by design, Eric, if you listen to him, he invests in people, in management, in areas that he, believes in projects, and he certainly does his own work from a standpoint of the evaluating assets in exploration companies and that type of thing. But very successful in dealing with managements and letting them build the companies. And so Eric's had some been out of the country quite a bit here recently. If people maybe noticed that he's not doing, somebody's been subbing for him on his weekly podcasts. And that's I don't know if I'm going to say whatever reason they're giving on the podcast for Eric's absence. I'd refer everybody to that. But Eric is, we are his royalty company. I don't believe he is not invested in any other royalty company that I know of, and that includes any of the new ones that have come out. So he's very committed to us. He's not a seller, but we haven't seen him be quite as vocal about the stock on his podcast.
Okay. And one last question here, Trey. Chris is just asking, do you plan on issuing equity to finance royalty purchases in 2021?
Well, it depends on the royalty purchase. I would say that if we do our job, the answer is yes. That we would be, issuing equity. Again, why it's so important to in this competitive environment to stay focused on the business model, which is you won't see us buying expiration royalties and spending our cash or dipping into our line of credit to buy anything that goes into the expiration would be the equivalent of our expiration 40 expiration assets. On development assets, it's typical, we did the Cote thing, very special. That's probably the most $2.5 million that we spent for a development royalty, but we think it's a very good story, and we'd actually like to add some more around there if we for what we think is going on there. So on the key assets, if we're mostly focused, and I would say that a large purchase that would be require us to finance would be a key asset, and as long as we're trading at call it 1x NAV, you wouldn't see us buying something even at 1x NAV. I mean, it would be to finance something accretive where we were buying it at 0.5x NAV. Maybe if it was just something really great, 0.7x NAV. But we want to do, if we were going to do a financing and having to figure in the costs of financing, the fees and everything else, and possibility of more warrants and discounts depending on the market, then it would have to be accretive at below our current price to NAV. And so, having said that, I think, look, we have $7 million in cash. We've got the $6 million line of credit. We could do, we've got a couple things we're looking at right now, which would be very nice additions that that we could handle without having to raise money. So ideally, we would, we still have powder dry, and we would hope to see the market get squared away a bit, and be able to issue, if we have to issue equity, be doing it at a higher price, and not really looking to issue equity when we're trading at less than 1x NAV.
Okay. Understandable. Well, Trey, this has been a good one. Lots of questions, lots of good participation as always. So thank you everybody that attended, and especially those who did ask questions and got that good engagement. Trey, any closing remarks before we shut it down?
No, I think, just thanks everybody for coming. I mean, I love doing these things. It's a lot easier for me. The social media, I think it can be difficult to stay on top of and communicate with everybody that way. So I'm glad to have people, participating here. We want to do more of them. I mean, we will continue to do more of them for sure. Happy to spend the extra time on here with everybody and get questions answered. I mean, as some of most of you, I'm pretty good about answering emails and answering specific questions if they have them. Joanne, of course, is also actionable when we have requests. So I just want to thank everybody for hanging in there, for listening to this story, for being shareholders. I mean, it's all about you guys, you people out there. If we didn't have you, we wouldn't be able to do any of this. And we're working very hard, and we have, as I said, one goal, and that's to increase shareholder value. And if there's a way to do it, we're thinking about it.
Okay. Well, with that, I think we'll wrap it up. The final results of the poll, for anyone curious, 85% either think gold is up slightly or significantly higher over the next 3 months. About 60% people said slightly higher, and about 27% said significantly higher. So we'll see come next time we run this. It's always good to see everybody's thoughts on that. But thank you again for everyone for joining. If you do hang around, there will be a quick survey after the webinar finishes. If you want to fill that out, we always appreciate that. So until then, everyone stay safe, take care, and good luck with your investing. Cheers.
Thanks again, everybody.